Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, to help boost your trading potential. Coming up, renowned economist and investment strategist Ed Yardeni joins us in just a few minutes' time as he rethinks tech, trims his bear market odds to 20%, and lays out where he sees the S&P 500 climbing to 7,700 by the end of 2026. Plus, we're going to get his take on what investors should expect from the Fed in the new year. It's a lot of stuff. And in today's technical take, we're taking a closer look at small caps. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour into the trading day, let's check in on the S&P 500. Yes, the market got its rate cut yesterday afternoon and rallied off of that news today. We have some downward pressure because we're back to talking about tech stocks. Let's jump into the heat map. I think it's become pretty clear what's going on right now in terms of the market. While we have Nvidia, Apple, Google all in the red. Check out Oracle right here, down about 15%. Let's jump right into this name, start to figure out what the story is here. It's basically earnings. And it's dragging down the whole AI space with it. The cloud computing and database software maker reporting lower than expected quarterly revenue on Wednesday. That was the disappointment. They say that demand is booming for their AI infrastructure, yet revenue disappoints. And recall, it raised $18 billion in a pretty big, some are saying, a jumbo bond sale back in September. So this is a stock that's, wants to perform to perfection. And when it doesn't, this is the kind of result we get for Oracle out of the gate. And as we said, it's really pulling back the broader market with it. In a different space, Eli Lilly's out saying its next generation obesity drug delivered what appears to be the highest weight loss that it has seen so far in late stage trials. And it also, beyond the weight loss, reduced knee arthritis pain. So this clears it for the first of now several more upcoming studies on what's going to be a weekly injection if they can get it to market. The stock had a bit of a pop on that news earlier, but it's starting to come back to just sort of the flat line. And that's your market update. Joining us now from New York is Ed Yardeni, President and Chief Investment Strategist of Yardeni Research. And before we dive in, just a reminder to our viewers that the views and forecasts expressed are solely those of Ed and his team at Yardeni Research and based on their research. Of course, Here in Amin, co-host of the program, is with us as well. Ed, we got the cut we were expecting yesterday afternoon. Also, that $40 billion in Treasury bill purchases. How does this affect your view of 2026 for the S&P 500?
Well, I'm still bullish on the market. I've been bullish since October 2022, and the bull market continues by earnings. The earnings story is still intact. I think the economy is still intact. I don't see a recession next year, and usually what causes corrections and/or recessions is the perception that a recession is coming or that it's actually here. And I don't see that happening in 2026. Quite the opposite. It looks like we're going to get a lot of fiscal stimulus. This big, beautiful bill is retroactive to the beginning of this year, which means that a lot of people are going to get some substantial refunds for that tax cuts in 2026 and in April. So that'll be very stimulative. So I've got the market going to 7,700 by the end of next year. Right now, around 7,000, so it's a 10% increase.
So you got that call on the S&P 500. You see the fiscal stimulus. When it comes to the Fed, do you think we're going to get much more monetary stimulus? We got the cut the market was waiting for. FOMC is sort of split along lines as to what happens next and how many more cuts we can get in 2026. How do you see that going forward for the Fed?
Well, at this point, I think the Fed is back to pause mode, back to there's no rush to lower interest rates. They've already cut by 175 basis points since September of 2024. I don't think there's a need for them to cut anymore. I think they're going to kind of sit back and have a look to see how the data shows the economy responding to the monetary easing. By the way, Powell, in his press conference yesterday, acknowledged that the economy in terms of real GDP is doing just fine. The main concern is the labor market, and there's some funky things going on there. And I'm not quite sure that lowering interest rates is going to really help create more jobs, because I think there's a lot of it is related to a supply issue. tougher immigration and deportation policies. And on top of that, we've got the whole AI phenomenon that's probably driving productivity. So the good news is productivity is going to drive economic growth next year.
So Ed, let's talk about Fed Chair Powell for a moment, because he's got, so after this meeting, 3 more meetings. There's no rate cuts happening before he hands over the reins. He came out and said he wants to give to the incumbent Fed chair the economy, put it on fairly stable footing. So let's talk about inflation, because inflation's remained sticky at 2.8%, and he wants to get him back to 2%. Do you see, with stimulus coming, the tariffs still, inflation remaining at 2.8, or do you think by the May, turnover, we're going to see it back to the 2% level that they want? And what's the upside risk to inflation?
I think it's possible. I think when you look at the CPI, or the consumption deflator, which is an alternative measure of consumer prices, what you clearly see is that inflation was coming down. It did come down to 3% from about 9% in its peak. But it probably would have been down to 2% by now had it not been for the tariffs. And the administration says, of course, that tariffs have had no impact on inflation. That's not quite accurate if you look at durable goods inflation. So we've got services, and we've got non-durables and durable goods. And durable goods inflation has definitely increased. It was actually falling for a little while, which is what historically durable goods inflation tends to do. It tends to deflate. But the tariffs stop that in its tracks. And I think that the tariff impact will diminish over time. And maybe by the time Powell leaves, we'll see the inflation rate down to 2%.
Okay. Now, with the Fed easing, you've also noted concerns about bond vigilantes, especially with deficit swelling in 2026.
Yeah.
We know the 10-year Treasury is kind of edging higher. It's at above the 4% rate right now. So could the U.S. face a Japan or UK-style yield spike higher? And what's the transmission into equities if that happens? Yeah,
it's probably my main concern looking into 2026. I think it'll be another good year overall for the economy and the stock market. But it won't be so good if the if it turns out to be the year of the bond vigilantes. And right now, 2025, this year, has turned out to be the year of the bond vigilantes in Japan, and the Japanese bond yields have soared because the central bank over there is stepping on the brakes, trying to bring inflation down, but the fiscal authorities are worried about a recession, and so they want to stimulate, and so it's a real mess. Similar fiscal problems are pushing bond yields up in the UK. I don't think the United States is going to have a debt crisis in 2026. I think that for one thing, the Treasury has figured out that they could play what's called yield curve control. In other words, if the bond market's not happy, then they'll just issue more bills to fund their deficits and reduce the amount of bonds. And that seemed to work in 2023 when the bond yield soared from 4 to 5% in just a few months. And Treasury Secretary Yellen at the time issued more bills, and that calmed everybody down in the bond market. The other development here is in July, Congress passed and the President signed the so-called Genius Act, which basically regulates stablecoin, and stable is kind of Venmo for business and international transactions. And that stablecoin is supposed to be backed up by liquid assets. So it'll mostly be Treasury bills. So it did create another demand for Treasury bills. So I'm not particularly concerned that we're going to see a spike in yields. But I do think we're going to continue to see a fairly steep yield curve compared to what it had been over the past few years, where the bond yield, I think, stays above 4%. And that, of course, exceeds where short-term rates are now.
And so there's your view on the fixed income market and talking bonds. I want to get some of your views on equities. We talked broadly about the S&P 500 off the top. For 15 years, you had an overweight recommendation for tech and communications services. You have ended that recommendation. Tell me the thinking behind that, and how should we approach these sectors next year?
Well, it's worked all too well. It's been a successful successful concept. It's to the point where if you look at the S&P 500 and you look at the market capitalization of the S&P 500 that is attributable just to 2 of the 11 sectors, which is information technology and communication services, you're at 45%. I mean, it's very, very concentrated. We could do the similar analysis with the Magnificent Seven. They account for 30% of the market cap of the S&P 500. So I just realized that I was sort of like at a logical tipping point here, where I was saying, okay, we should overweight information technology and communication services. And then I thought, so really? I mean, it's already 45% of the S&P 500. Do I really want to tell people to have 50, 60, 70% of their money in just two sectors? And the answer is no. I still believe that some amount of diversification is important. And I also, over the past few weeks, have observed, as we all have, that the AI infrastructure model, the Magnificent Seven model, it's turning a lot more competitive. I kind of made an analogy with Game of Thrones, you know. In the starting credits, they've got the towers going up and down, signifying that one kingdom is becoming superior to, and another one's falling. But for a while there, they all had the Magnificent Seven all had moats around them, and they all prospered just fine without really getting into each other's business. But now they're getting into each other's business. It's becoming more competitive. And by the way, technology is a fiercely competitive industry historically. They literally eat their young. As soon as they produce one new hardware or software, the companies that did that are already working on the next version. Look at NVIDIA is going. You know, they're basically saying we'll have a new chip for you every year. But then all of a sudden, Google comes out and says, "Well, we've got TPUs to match your GPUs," and so it's become a Game of Thrones in terms of the competition among these various IT kingdoms.
So let me pick on that a little bit with you, Ed, because so you've prompted this big change, and specifically really centered around the Mag 7s, the underweight stance. Do you think this is more a cyclical pause, or we're at a structural juncture right now? There's a structural change happening, and for what future developments would you think would cause you to reconsider going overweight again back?
Well, I think before AI, they all had their own businesses. You know, Google had its search. Facebook had its faces and so on and so forth, and they didn't really overlap that much. AI suddenly kind of forces competition on them with one another, and it also seems to be no shortage of venture capital available to fund just about any cockamamie idea of how to take on these big players. So I think competition is here to stay. I think they've gone sort of from an oligopoly situation to a very competitive environment. That means that their profit margins are probably going to get hit to a certain extent, or at least the growth rates that they've been able to sustain in earnings are going to get hit. And that might cause investors to reconsider some of these valuation multiples. But look, it's not as though there aren't other opportunities to invest. So we've all focused on the Magnificent Seven. There's also what I call the impressive 493. I mean, these are perfectly good companies. If the Magnificent Seven didn't exist, these other companies would still have been fueling a bull market, in my opinion.
So let me just pick on the Game of Thrones theme for a second, because you say not overweight. And I cast my mind to Game of Thrones because I'm a big fan of it, and I remember the red wedding scene. You remember that, the complete gore. Yeah. So is this, and can I use that proxy to say this is what could result in the Mag 7, just because you mentioned valuation, competitive moats are kind of, you know, dismantling now by the other 493. So what do you say to that?
I don't think everybody's going to die. I mean, there's going to be death along the way here, but you know, I think what just happened here with Google introducing Gemini 3, which apparently is better than ChatGPT, certainly created a existential threat to OpenAI, which isn't a public company, but it's sort of been the kingdom that was on top in terms of its relationships with everybody else. But if ChatGPT isn't going to be the primo large language model, instead it's going to be Gemini 3, then how's the revenues of ChatGPT going to pay for all the commitments that OpenAI has made? So as a result, Sam Altman, who runs the outfit OpenAI, declared code red. I mean, he's obviously saying the potential for death if they don't respond quickly to this threat. And by the way, meanwhile, I think a day or two after Google introduced Gemini 3, guess what? Remember DeepSeek?
Yeah.
DeepSeek caused the correction at the beginning of the year for the Magnificent Seven. It wasn't just the tariffs. It was also DeepSeek saying, hey, we got a pretty good AI model here that didn't really require these heavy-duty chips to create. And here DeepSeek just came out and said, well, we've got a competitor to Gemini 3. So this is going to be an ongoing competitive situation. And I think it's going to be hard for investors to completely sort it out. I mean, Michael Berry, raised the issue of depreciation periods for the GPU chips. And the answer is he might be right. Nobody really knows exactly how it all plays out in terms of earnings for these companies.
All right, so tech definitely going to be interesting still heading into 2026. We'll see who survives each episode because I'm a big fan of the show too. I want to get back to the fiscal stuff you were talking off the top, the one big beautiful bill, the stimulus it's going to put into the economy. How much of your call on the markets in the S&P 500 depends on all of that sort of fiscal stimulus and that bill sort of landing cleanly into the U.S. economy?
Well, it doesn't depend a great deal on it, partly because I'm sort of a natural-born optimist. And over the past several years, I didn't get into trouble with that. It actually worked remarkably well. I was one of the few who argued we wouldn't have a recession. And as you know, over the past few years, we've had the most widely anticipated recession of all times that didn't happen. And I kept saying that the economy is resilient and it's withstood all of these shocks. I mean, think about it: pandemic, lockdowns, social distancing. Then we had Russia invade the Ukraine. We had supply chain disruptions, inflation. The Fed tightened. Tariffs, and here we basically have had one recession that entire period, and it was artificial. It was that lockdown for 2 months, and that's how long the recession lasted. And then the economy recovered remarkably quickly. So I'm betting on the resilience of the economy, and if that's the case, I'm betting that that there won't be a recession between now and the end of the decade. I call the decade the Roaring 2020s. So far, so good. Things could go wrong, I suppose, but right now I'm betting that the overall economy is resilient. Consumer spending remains strong, I think, partly because baby boomers are retiring. It's the richest retiring generation ever. They're retiring with $80 trillion of net worth. They paid off their mortgages to a large extent. So that's keeping the consumers going. I think there's a lot of trickle down from the baby boomers to their young adult children. They're helping them out. Capital spending has been remarkably resilient. And then, yes, fiscal stimulus has been an important part of why the economy has been resilient. But that will continue with the refunds from the One Big Beautiful Bill Act. But it's not the only reason why I'm betting that the economy will grow.
Okay. Ed, let's talk about the things that can go wrong, though. So you did lower the odds of a bear market down to 20%, but there are whisperings about risks like the private credit market that may, some liken it to maybe a crisis unfolding like the subprime mortgage crisis that we had. And AI valuation and bubble talk, of course, is always frothing. So which of these do you see as the most likely to challenge the bullish case or raise the odds of a bear one?
Well, actually, those are concerns for sure. I would say that it's a good thing that people are nervous and that there's sort of like a list that the pessimists are keeping us on top of what could possibly go wrong. So that's the fact that so many people are addressing the question of whether it's an AI bubble or not is a good thing. I don't remember in 1999. When we were going through the tech bubble back then, I just don't recall that anybody was really raising the flag. Nobody was talking about a dot-com bubble or a telecommunications a hardware bubble. seller financing bubble? Nobody. And then it just kind of blew up. I remember one fellow in Boston who managed money for a big mutual fund, and he was adamant that Cisco was a big scam. And he got fired a few months before the tech wreck started. So it was just bad timing for him. But it was almost like a religious cult view that, this internet was going to just create all sorts of opportunities. And it did, but it also created a red wedding, as you said before, in the telecommunications hardware sector. I think that all in all, the economy's going to be resilient enough to keep the troubles at bay. But I would actually say the bond vigilantes worry me. I coined that phrase back in 1983, and I went back and read what I wrote, and I wrote that bond vigilantes would take law and order into their own hands if they felt that fiscal and monetary policymakers weren't acting properly as the sheriffs, keeping law and order in the capital markets. And I said that the bond vigilantes were particularly concerned about $250 billion of deficits. Now we're talking about, in an economy that's growing, having a $1.5 to $2 trillion deficit. We could have the bond vigilantes coming back from Japan or the UK or spreading out and saying, that they don't like what's going on in the US. And it may very well be that when all these refunds have to be paid for for this year's retroactive tax cuts, that suddenly that'll remind everybody just how awful the federal deficit is, and maybe we'll have some sort of backup in bond yields that create some problems for the market. But this problem was created by humans. It can be resolved by humans. Maybe we need the bond market to give us a good shock and scare in order to bring some discipline back into the whole fiscal picture.
I like that the humans created the system. Right? Sometimes we feel like the markets are so big that we can't control them. It's like, we created the markets. I would hope someone could figure it out. We've covered a lot of ground, Ed, a lot of fascinating stuff. You do have that target for the S&P 500 of 7,700. You're not overweight tech anymore because it makes such a huge component of the market. What does look attractive then for 2026?
Well, by the way, I should throw in that in my roaring 2020 scenario, which is so far so good, I'm talking about the S&P getting up to 10,000 by the end of the decade, so by the end of 2029. And that's on earnings. Earnings look like they're going to be about $300 a share for the S&P 500 next year. I think the market's going to be discounting $500 a share by the end of 2029. In other words, the market looks forward, and I think for 2030, the market will be looking at $500 a share. 500 times a high multiple, but reasonable multiples nevertheless of 20 gets us to 10,000. Along the way, I have no problems with owning tech or communication services. I just, as a strategist, I don't want to be recommending overweighting two sectors that are already overweight in the markets, overweight relative to the economy. The economy, technology and communication services are not 45% of the economy the way they are of the S&P 500. And oh, by the way, there's when you look at it from a Magnificent Seven perspective, there is the impressive 493, as I like to call them. And the Magnificent Seven aren't going to stay in business very long if they just kind of do circular financing with each other and buy each other's chips and compete with each other's LLMs. They have to have customers in the 493 and beyond. And so I think I've got this notion that maybe we should think of all companies as technology companies. They either make it or they use it. So I'm keen on the market broadening out to the 493. I have been recommending financials. I would add to that position even now, and they've worked. Had a good day yesterday. I would add to industrials. I've had an overweight on that. What I haven't really paid any attention to is healthcare, and now I'm recommending overweighting healthcare, particularly biotech and maybe even pharma. I know pharma is going to have some pricing pressure, political pressure, but as we can see, they're constantly coming up with drugs like weight loss drugs and all that can really create some home runs.
Ed, fascinating discussion. Thanks so much for joining us. My 22-year-old son is going to love this chat because he has just started investing at small amounts, but every month into an S&P 500 ETF. So when I tell him your call for the end of 2029, I think he's going to be smiling tonight.
Great.
All right, Ed, thanks so much for your time. That was Ed Yardeni, President and Chief Investment Strategist of Yardeni Research. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Herein, I don't even know where to begin. There was so much fascinating stuff in that discussion. Maybe I'll take it back to the top when I was starting to make some notes on when he was talking about he's betting on the resilience of the economy. He thinks the economy is fine. Jobs, I can't remember if he used the word funky or funny, but something he said the jobs market, lower rates. Because we started off by talking about the Fed, right? And the market got its rate cut yesterday. He said lower rates aren't going to fix what's happening in the U.S. labor market right now. It's an immigration and deportation story. It's an AI story. That really made me think about the limitations of what a central bank can do. They already told us they can't fix trade wars.
Yeah, no, absolutely, Greg. I mean, he made a great point about that, and there's obviously something that's going on beyond than what we see outwardly and what's been attributed to the labor market disruption there. The other thing that he mentioned was we talked about inflation as well, which are the two primary gauges. They want to support the labor market, but also look at inflation, and inflation's been very stubborn. But I'm surprised to say that he said that despite the stimulus and everything that's going to come on, he thinks that there's a potential for inflation to come down and trickle back towards that 2% target that they have. But also, we should maybe take a moment and pay homage to the 493, Greg. Often the ones that get missed out collectively, but specifically the industrials. You've got the pharma, or healthcare, I should say, and financials. I know they've been having a bit of a strong run as well. So some key focus areas as well, probably going into 2026 here.
Yeah, so much good stuff there. And then the 2029 call of 10,000 made my eyebrows go higher, too. I think we have a lot we can keep digging through on this one. We probably could have talked with Ed all day, but obviously we got some more show to come. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. You just open a practice account, you click on the Try TD Active Trader button. Then when you're ready to switch to a live account, you simply export that workspace, start trading for real. Right now, for more technical take on what's happening in the markets here, and you got a closer look at the small cap space. Walk us through it.
Yeah, Greg, we're looking at IWM. It's the iShares, ETF that tracks the Russell 2000 index. Remember, the Russell 2000 is a key gauge for the overall performance of small caps and mid cap stocks. Now, the reason I want to look at it is because it just hit a record, obviously on the backs of the FOMC decision yesterday, but it hit a record high, all-time high, in fact. And small caps tend to benefit disproportionately from looser financial conditions. Now, one of the reasons is obviously starting to come around is for years, the big brothers and sisters, and I'm talking about the large caps and the mega caps, the mids, they've already broken out to new all-time highs. But, small caps haven't quite participated in the same sense until now. And that's because we now have conditions where rates are coming down. So you'll recall that smaller companies are more sensitive to interest rates. And they don't quite have the buying power, the financial leverage that big companies do. So when rates do come down, this is seen as being very business friendly, especially for this category of businesses which are considered to be very risky, and for those smaller mom and pop shops out there. So what we also want to see is participation. One thing we look at technicals is healthy bull market continuations have to have supporting X. And small caps is a big part of that. So if the small caps are underperforming and you have the bigger or large caps, making, going the other direction, then that could indicate to us that the market's poised for a downturn. But when they're all singing from the same hymn book, then we know that the structure is strong and it's in place for the broader continuation of the bullish run here. So let's go and pull up IWM's chart and see what the story's unfolded here so far. So I've got the daily chart up here, Greg. We're looking at the yearly look. I'm going to expand it down. I just want for a second to just show this is going back to late 2021. We see the small caps kind of tag this key ceiling level. This is a support, I'm calling it support now, but used to be a very strong resistance area at the 245 mark. It rejected off of that. We saw this big cycle downwards for the 2022 period right into late 2024, where we saw the cyclical big move. in what's forming a telltale pattern that I love, the cup and handle, of course. This is a wide base that it's formed, and that just means that it's like a coil spring that's waiting to be shot up once it does break up above this key level, and we did in fact have that. So we saw it tested it late in 2024 here going to this new year. It wasn't able to crack it, but it did finally crack it going into this October cycle. We had a fake out. This is what's called a fake out. So it did test it. We didn't result in a new higher high on a consecutive follow-up. So we did trickle downwards again. We saw this big bear bullish flag that has formed, and we had a breakout form out of this bullish flag. And this is a key breakout. It's a strong move because we saw three strong bullish daily candles that formed. This is a formation that's known as the three white soldiers, and that led to a breakout of that 245 level. But more importantly, yesterday's FOMC was the key catalyst to break above the 252 level, which was a key previous all-time high back in, October, that is now broken through and is now making a newer higher high. So this is a key one to look out. Structurally, we've formed new highs. They're all kind of in the same book. We see momentum kind of also heading northwards as well. So very strong bullish indications going into the new year and really corroborating that Santa Claus rally that we are expecting to come through by the end of this year.
There on the small caps, Russell 2000. You're also going to take us on a cruise.
I am going to take you on a cruise, Greg. I don't know if you got the cruise bug, but it seems to be more and more people are adopting to the cruise industry or cruise line specifically. So the one I'm looking at, of course, is going to be Carnival Corporation. Ticker symbol is CCL. The reason we want to look at this is because they, in fact, are going to be one of the first companies out of the cruise companies to report earnings coming out of end of next week on December 19th. Expectation is to do about 24 cents EPS. That's marking a 71% growth year over year and revenue of $6.36 billion. Now, remember, this is an industry that has been battered and beaten since the COVID, coming out of COVID. Carnival has been perhaps more susceptible than any other cruise line because of the burdening debt load that it's taken on. It went from about $9 billion just pre-COVID to $25 billion to kind of where it stands. But what they're doing from the last few earnings, they've been improving their balance sheet significantly. And that's a key thing that investors are going to look forward to. One is they've gone free cash flow. They've hit the $2 billion free cash flow for the quarter, which is the first time since the COVID era. But also they've improved their return on capital, hitting 13% based on the last earnings report that they came out with, which is the highest level they've had since 2007. Now, what's going to be key coming into this earnings is a couple things. We want to see what management has to say with the improving leverage profile. We know that they're not taking new ship deliveries for 2026. They have one for 2027 and one for thereafter. So they're really focusing on reducing CapEx, and it's been the lowest in several years. But also on the demand side of things, they've already booked about half of 2026 capacity at the higher prices. And we've seen expanding cruise capacity across the Caribbean for newer adopters of cruising who prefer to stay closer to home, but also prefer to have shorter duration itineraries as well. And Carnival stands to benefit from that demand here. So looking at the price, though, this seems to be the story that we're seeing. I've switched it out. I've got a zoomed out look, and what I'm looking at is weekly candlesticks that we're looking at. So we see the big sort of downslide that took place in 2022. And then at the end of, leading into mid-2023, we did see this bullish channel that has started to form. It respected that bullish channel going into this year. Of course, we saw it reject off the upper band. It actually broke through a new high that I marked. This was the previous 2021 high, and it just broke that kind of in mid-summer or towards the end of summer. We did see a trickling down effect. So at this point, I do see it in the mid-range of the channel here, but we do see a very healthy movement making new higher highs, as you can see, and new higher lows as we trudge towards the next resistance level, which might be that 32, which could act as that support here, Greg.
All right, we got our resistance line, our possible support lines. Feels natural that you're going to walk us through a couple ways we could trade Carnival. Before we get started on that, though, here, and I just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Here, and take it away.
Yeah, Greg, let's start with the bullish trade, of course. So again, we know that earnings is coming out. We looked at the resistance lines. One of the options you can do, and especially with a stock like Carnival, which is a low price stock, like 25, and I say low price comparatively to a triple digit stock, you have options that are going to be relatively more easier on the wallet. And especially with the volatility right now, the VIX is low. it's more conducive to go long. So one of the strategies we're going to look at is doing a diagonal bull call spread strategy. So we're really looking to aim far out into the expiry here. We're looking to buy a next year December 26 call, 25 strike, because we're looking for the upside to break through above that 32 strike and higher than that. And then what we want to do is just to take away some of the cost, because we have a long duration, is to just sell a near-term call further out of the money, in this case the 32, which is kind of that support or resistance area at the moment. This results in a 7-point wide spread until February. Right now this trade is costing, we're paying about $5, so it's a total of $500 is what we're spending. And we're expecting at least that by this duration, we want the stock to cross above our cost. And you can see our break-even price here is $30, Greg. So we want the stock to be above at least $30 by that February cycle. We'd rather take a breather at the 32 just so we can max out our profit. In this case, well, I'm gonna jump ahead and tell you about the profit because I have it on screen. We'll be making $2 or $200 on a single contract over here. Now, one thing that's unique though, Greg, you can see this is a shorter term option and this is a longer dated option, is we can keep repeating the selling of a call to further reduce our cost down as we go into this December cycle. So as the stock keeps moving up, we keep selling calls further out to further capitalize on an upward move if that's what we're expecting over here.
All right, interesting strategy there on the bullish side. The max loss, I think you had on our screen there for us as well, because there's always risk, right?
There is, yes. And in this case, it's only the initial debit that we're paying. So because this is a net long trade, we're spending money on this trade. We're paying $5. In other words, it's $500. So should the story not play out the way we want it to, and Carnival stays below 25, and there's a long duration, long time to go, a full year, then we would stand to lose the $5 that we're putting in. But remember, this gets marginally less and less as we sell calls throughout the cycle leading up to the December expiry there.
All right, interesting strategy with your bull. What if you're a little bearish? You don't like the high seas, you don't like the big boats, and you want to do a bearish option on it.
Yeah,
So
if you've got a bearish inkling or sentiment towards it, I'm going to play on the thesis of the fact that volatility is low, which makes it more conducive and more cost effective to go long on a strategy. And we're going to do a very plain vanilla buying a long put option. This is a pure bearish speculation trade. We think maybe we can crack below the 25. What is acting as a support right now, you can see we're marked right at this level, but if it breaks below, it could further test down to the next area of support, which is the $20 mark here. So in this case, we're going near term. We're going to the December cycle for this month, so the last expiry for the year that's available to us. It is fairly cost efficient because this trade costs a whopping 60 cents, Greg. In other words, $60 if you do a single contract. And so our break even means that we need the stock to at least come down to 24.40 before we start getting into the profit zone here. Of course, the ideal circumstances, we want it to be fully profitable. You want the stock goes to zero. Obviously, the chances of that, the odds of that happening are very minimal. But in that case, if we do have the stock completely collapse for whatever reason, then we stand to make the most profit on this trade, which is $2,440 over here.
Interesting stuff as always. Almost at the end of our show for this week. And as always, investors should perform their own due diligence before engaging in trading. We're going to be back next Tuesday with the big bull bear debate. What are we debating?
We're debating home manufacturer Lennar Corporation, Greg. So we're going to put the housing market to the test, see if there's actual improvements in there or structurally, or are we still in the doldrums with interest rates still staying, the yield still spiking high on the 10 years, and see what that means for the housing markets there.
We've had a lot of Brian Rogers guest star appearances. Next week is you and Jason. Is that what's going down?
Yeah, I'm going to close out the year, Greg. I thought I'd do that in a fitting manner, right? I think we've had enough Brian. I don't want to confuse you anymore about who gets to go, who starts off the show. So I'll be back on the chair again. I know you did a good job this week, though. So kudos.
Did you see Tuesday's show? You took a few shots at you, too.
I did indeed. So you got it squared and you got it right.
We all want to know if you're going to be wearing your leggings, but we'll save that for Tuesday to find out. We'll do a wide
He
shot.
did take a dig at me, so I'm gonna have to exact one back at him for next week. So stay tuned for that one.
There will be payback. All right, you're going to want to miss it. Thanks for watching this program. We'll see you on Tuesday.